Jeff?
That is my coffee slash protein drink, all mixed into one. Gotta have my energy for my 4:30 meetings.
Hello, Ms. Donaldson. I can't hear you. You're on mute.
Oh, hello.
Hey, how you doing?
I'm okay.
Good, good.
And Jeff, is Walda joining?
She is not. She's tied up in some travel, I think.
Okay. Okay, gotcha. All right, we are live. Oh, I think we have Dr. Sanders joining and we have Kim. So two of the co-chairs here, whoever wants to kick off the meeting.
Kim, you want to go on and take us live so we can get started?
Yes. Is there something I need to read or just go ahead and open up the meeting?
Just open it up and then ask for roll call.
Okay. I would like to, good evening, good afternoon, everyone. I would like to open up the investment committee meeting today, Thursday, March 19th. Susan, can we go ahead with roll call?
Christina Bennett. Candace Carter Oliver.
Present.
Louis Cross.
Present.
Mary Donaldson.
Present.
William Heisey.
Present.
Emily Hubbard. Kimberly Johnson.
Present.
Shanice Johnson.
Present.
Yvette Levy. Jennifer Orr. Albert Sanders.
Present.
Andrew Bean.
Present.
Doris Walker.
Here. Albert, what's that behind your head?
A rat. Our pet rat. It's a cat.
So we do have 9. We have a quorum. So Jeff, I guess you're up.
Okay, sorry, you're all waiting on me. So good afternoon, everyone, and happy almost spring. I think tomorrow's the first day of spring, and the weather might actually start to act like it. So it's been up and down, and we had snow and craziness here, but I think it's finally starting to warm up. So in any event, we have Grosvenor on the agenda first, and this is one of your hedge fund of funds manager. So just because we have a handful of other items that we need to get on the agenda, we just told them to keep it to a half hour of an update on their firm. Normally we would have liked to have them do some education, but we ran out of time for that today. So we'll have them provide an update, and hopefully you can get a good idea of what's going on there. But it's at some point I think we certainly want to spend a little bit more time on doing some education on the hedge fund segment of the system. So we'll make sure we get that lined up at some juncture. So with that, Sue, if you want to bring in the folks from Grosvenor.
Yeah, could there be 4 of them?
Probably.
Okay. All right.
Christina's by phone. You see that?
Yeah, Christina
Is
has
she on?
joined.
Okay.
Yeah. All
Hi,
right.
everyone.
Hey, Christine.
Christina.
Name her.
Okay.
So good afternoon to the team from Grosvenor.
Hello.
Good afternoon.
Good afternoon.
Good afternoon, everyone.
Good afternoon.
Good afternoon. So, I gave the committee just a quick heads up on the agenda for the meeting. Again, 30 minutes. Love to get an update on the firm and the process and strategy. Again, we would have loved to had a little more time to go over some educational items, but we'll just keep it to a half hour on an update today and anything you want to share. And I'll hand it over to the folks at Grosvenor.
Jeff, thanks a lot. Just one housekeeping issue. Is this the presentation that we sent? Is someone going to be kind of driving on your side, or should we be?
Yeah, I'll
Okay.
pull that up here in just a bit, and
Great.
you let me know just where you want to go in the presentation.
Thank you so much, Sue. Really appreciate it. So I'll start. My name is Sean Conroy, and I work with Grosvenor Capital Management on the client side. Want to thank you, for your investments, both in the absolute return strategies as well as private equity. Joining me today, and you're going to hear from David Richter first. David is a managing director and the chair of our investment committee on the absolute return strategies part of our business. And then after David, you're going to hear from two of our folks on the private equity side. You have Steve Kamek and Jess Holsey, both managing directors and the co-portfolio managers for our advanced strategies. So just wanted to make sure that you knew who was on the phone, who was on the Zoom. And with that, Sue, I'd love to go to page 3 and kind of kick it off, just giving you a little backdrop on the firm today before handing it over to David. All right, great. So as a refresher for some and maybe new for others, Grosvenor is an organization that's been around since 1971. So over 50 years of alternative investing. Today, we're currently managing over 91 billion. And if you look at that top right, 64 billion in private markets and 27 billion in absolute return strategies. So we're going to talk about both of those areas within the organization today. Other areas of the organization that we also are working and currently investing in are in the infrastructure and the credit and the real estate side. And we think collectively these all these investment groups working collectively give us a great edge in the marketplace as it relates to what we are seeing and sharing within the Grosvenor world today to work with the products. 553 employees. Of which 185 are investment professionals. So you have David, Jess, and Steve representing our investment professionals. Currently headquartered out of Chicago with a large presence out of New York. We also have offices throughout the world within Europe and Asia. So deep research coverage. With that, unless there's any questions on the organization, I'm going to hand it over to David to be mindful of the time and talk about your investment in GIP. All right, David, where should they go?
Sorry, I was on mute. Hi, everyone. Thank you, Sean. Good afternoon. Hi, Jeff. First of all, Sean gave me 10 minutes, but I think I could do my part in 9, so I'll do my best. As Sean mentioned, I lead the hedge fund business at our firm. I've been here 32 years. I'm really pleased to give you an update. Really appreciate your partnership for many years, and I want to thank you all for that. Before diving in, I will say this is a really good time to be hedged. Right now we have high degree of uncertainty in the world, risky markets, risky geopolitical, macroeconomic landscape. Markets are expensive, but hedge funds have been doing quite well in this type of environment. Uncertainty, generally speaking, is a tailwind for hedge funds, even though it can be a headwind for traditional assets. So it's much better environment today than it was in the interest rate years of kind of following the great financial crisis. So I'm going to just use 3 slides, and the first one is on page 6. There. Okay, so what are you invested in? You are invested in our flagship fund called GIP, Grosvenor Institutional Partners. It is a 25-year-old fund, $5 billion, and contains the world's most desirable hedge funds, basically. It shows on this page that returns have been quite strong. Over the last 3 years, we've delivered to you a 12.5% net of all fees and expenses per year. And it's not shown on the page, but over the last 5 years, it's been about 9.1% net per year over the last 5 years. And that is exceeding our objectives. Our objectives is to deliver you risk-free returns +5. You can see on the right side of the page that we've beaten the industry benchmark, which is the HFRI Fund of Funds Composite Index, and we've also outperformed cash and bonds. One of the things that I am most proud of is the downside protection. We have had just under a 10% sensitivity to the markets, meaning when the markets go down, we may go down, but no more than 10% of what the markets go down. I'll give you a stat on that in a moment. And lastly, I'll just say that we're delivering this to you in a investor-friendly format. It's quarterly liquidity. There's no lockup of your capital. And we save you some fees versus what you would pay the hedge funds directly. Because of our size and scale, we get a discount with a number of the managers. If we flip to the next page, I'll just show you a little more about what you're invested in there. So we'll drill down here into the portfolio. There's 22 investment managers, meaning 22 elite hedge funds in here. And these are global asset management firms, 76% of which you could see on the top right there are closed or capacity constrained. What does that mean? That means these managers won't take new clients, and and the reason is that, and why is that important? It is because they are maintaining their discipline about how big they get so that they can continue to deliver returns. So in other words, you're invested with hedge fund managers that most people cannot access today because they're closed to new clients, but we've been with them for so many years that we have access. And in the middle there on the right, you see the 0.08. That's what I mentioned about downside capture. So when the markets have gone down, let's say the market goes down 10%, this portfolio would go down 0.8% on average, and that's what it's done since its inception, and also what it's been even a little better than that in recent years. And that's important because when there are disruptions in the market and the markets decline, and you're kind of flat, maybe a little bit down, a little bit up, it is excellent because it gives you the dry powder and the confidence to lean into the dislocations. And often in market declines, there are a number of dislocations. We're starting to see that this month, actually, given the disruption in the energy markets and in the broad markets. And then I guess the last page that I'll cover is on page 10. And then I can pause for a couple minutes to see if anybody has questions right here. So what are we really investing in? Because I could give you the names of these hedge funds and I'll give you some examples on this page, but I'm not sure if you've heard of them. But what really is important is for you to understand what we're really doing here. And so you can see this page is about rough numbers, 40% of GIP is in the top, the green, what we call market neutral, long short equity, and then about 40% in the bottom, which is diversifying strategies, which is global macro strategies, quant strategies, and relative value strategies. And in the middle is what we call alternative credit, which is long short credit trading, structured credit. It's non-traditional credit. None of this on this page is traditional assets, meaning any of this isn't long only stocks or bonds like you might get in the rest of your portfolio. This is all alternative, pretty liquid strategies that are hedged and that are long short. So on the top, examples would include Woodline, Maple Lane, D1, Aspects, if you've heard of any of these firms. And they focus on both picking stocks that will go up and picking stocks that they think will go down. And so they don't have a lot of market sensitivity. They're really focused on their fundamental research. And that is typically an edge that hedge funds have, especially in markets that are choppy, like right now. Alternative credit in the middle, these are strategies that are similar. Some of them are similar, like long short credit, where you can go long and short. You could bet against credits, and that is, but overall, this strategy has a bit of a nice yield to it. It's not super interesting right now, which is why it's only 20%. It's okay, but it's not great. If you saw credit spreads widen a lot and the market get really bad for credit, it's actually starting to, but if you saw it really get bad, you'd see us give more than 20% of the portfolio here. And then lastly, diversifying strategies on the bottom. These are market neutral, zero correlation strategies, relative value, quant strategies, including machine learning and AI-driven strategies. And these are strategies that are more complex, but they are important because they can generate good returns without any market sensitivity. And managers in that category you may have heard of, like Citadel, D.E. Shaw, QRT, Elliott is in that strategy. So those are just some examples there. So Jeff, Sean, I think with that, I'll pause. I hope I got it in 10 minutes, but if there are questions, I'm happy to answer now or at the end.
Yeah, thanks, David. That's very helpful. So you mentioned one important thing up front was the liquidity of the strategy, but and again, I don't want to go down the rabbit hole because I know there's so many different flavors of what you all do and how you diversify. But we've spent a lot of time with this group over the past year or so, filling out some of their private equity and private debt allocations, and we know you all do some of that too, but can you just at a high level, without going too far down the road here, just other than the liquidity, what are the differences here between what you do here and then what they're getting in their private equity and private debt allocations?
Yeah, good question. The main difference is on the short side. So if you're in private equity or private credit, you're typically correlated to the market, meaning it's different than stocks and bonds a regular way, but you still are depending on positive GDP, positive markets. They're more cyclical, so they'll generate a nice return in a normal world, but they don't actually make money when the markets go down. They may do better than broad stocks and bonds because they're idiosyncratic, meaning the managers are picking individual companies in private equity portfolio and private credit portfolio. So they're really good complements to a traditional stock and bond. But what you're getting in a hedge fund portfolio are all the managers in here have a part of their portfolio that are actually designed to make money in down markets. So your overall correlation is lower. So we're not trying to beat the stock market. For us, we're trying to deliver you risk-free, which is right now about 3.5 plus 5% per year, which is 8.5. We've been doing better. As I mentioned, it's been more like 12, but we're trying to deliver that without caring whether the market goes up or down. We want to be the part of your portfolio that lets you sleep at night without worrying about market direction.
Great. Thanks, David. Anyone else have questions? Okay.
Who are we going to? I think Jess, are you going to take over from here?
Yes,
Yep.
I will take over from here. Hello, everyone. Thank you again for having us. Thank you again for being investors and supporters of our Advance product. I'm Jessica Holsey, Managing Director on our private equity investments team. I'm one of the co-portfolio managers for our Advance fund. and would love to kind of give you an update on the portfolio and walk you through what we're seeing in the market. So we can start with slide 14, which is a snapshot of the Advance Fund. So what you'll see here is we're really happy with the portfolio construction. So we are 100% committed and reserved. So all of the investments are in the ground, and we're really entering into value creation phase. So our goal was really to build a well-diversified portfolio by investing with exceptional managers. You can see on the right side of the page, we have a mix of primary funds, co-investments where we're investing directly in companies alongside of our managers, and then secondaries where we're buying LP interests from other LPs in the market. We also have a good mix of established managers who've been around and are kind of cycle tested, and then emerging managers who are just starting out and building their firms funds 1, 2, and 3. And then on the bottom of the page, we really have optimized the portfolio around the types of assets we have exposure to. So we are more heavily skewed towards buyout. So businesses that have positive earnings, positive EBITDA, who are really looking to grow and execute on operational improvements. And then we also have exposure to growth equity, so businesses that are probably near break even and need capital to really grow and grow quickly. Special situations, those are more debt-oriented type strategies. And then we had the ability to go up to 10% with venture, but given the climate of high valuations when we were investing this, we chose to keep the venture capital exposure a bit lower. So ended up around 3% there. But overall, really happy with the composition of the portfolio and kind of walk through the performance and where we are at this stage in the life of the investments. If we go to the next page, you can see the performance broken out by the 3 types of strategies. I would just note the performance is early, but I think we're off to a great start here. So you can see when you look at the holding period, we're about 3.7 years. So the majority of the dollars are in the ground. We have about 16% left of dry powder. So we're really entering in that value creation phase. And one thing you can see is kind of across all 3 of the types of assets, the performance is kind of in line with each other. We would start to expect to see more markups, more distributions as the portfolio continues to mature, but we're already seeing some realizations in the portfolio. You can see that 119 in the middle for realizations. That's actually ticked up to over 130 million. So continuing to see some of the assets be realized both by the funds and then also some of the co-investments that were in directly. We can go to the next slide. So the next 3 slides are really just the individual positions in the portfolio. So I'll just note on the right side of the page, you can see the charts that highlight the portfolio construction. Again, we tried to diversify across various different attributes. Performance is still early, but we're seeing positive momentum and a lot of the investments in the portfolio. And every quarter we go through and we just kind of track and see where things are marking to plan. So we kind of categorize things as ahead of plan, on plan, and behind plan. So the majority are on and ahead of plan. There are some that are maybe a bit behind plan, but the majority of those ones, it's really more of a pacing issue, where especially given the 2021 as part of this vintage, we saw some of our managers who were prudent and actually held back, didn't invest at high valuations that they were seeing in 2021, and they're a little bit behind from a pacing standpoint. So some of those behind plan ones, it's more of a pacing consideration. There are a few managers that have seen some impairments, but those are really isolated to specific assets in their portfolios where there may have been some macro headwinds. So overall, we're really happy with the portfolio construction, we think there's some great managers in here. We're starting to see some meaningful markups in the portfolios. And again, we're starting to see some distribution activity. I thought I would maybe highlight a few of the names just to give you a sense of what's in the portfolio. So I'll just start on this page. Define Ventures, one of the venture managers we backed. This is a digital health focused manager. It was a woman who really kind of stood up the digital health business at Kleiner Perkins and then left to start her own fund. She had the backing of the partners at Kleiner. It was the first fund of someone that had left that the partners had backed. So we're excited about that one. A little bit further down the page, I'll highlight something a little bit different on the end of the spectrum, which is One Rock Capital Partners. This was a spin out from Ripplewood. They're middle market buyout manager. They focus on complex transactions and real economy businesses, more industrial oriented. So a bit different than that digital health piece on the venture side. Just to give an example, I'll flag Reverence, a sector specialist, focused on financial services. So think banks, payments, RIA platforms, those types of things. We've also done a lot of co-investments with Reverence in this portfolio, and they've just continued to be a very strong performer, strong and consistent performance. And then on the next page, if you flip, I'll just highlight one more fund, which I think is somewhat interesting, which is kind of mid-page, which is Harborview Royalties Fund. So this one would be one of the special situations investments that we did where they're investing in the IP of music and songs. So they've actually built a song catalog of 20,000 songs. So anytime you hear a Quincy Jones song, Kelly Clarkson song, Fleetwood Mac, Chaka Khan, Lil Wayne, name it, you probably have some exposure. You're actually making some money every time you're listening to those artists. So that's kind of a fun one that you have exposure to in this portfolio. And then if we flip to the next page, just on the co-investments and secondaries, this is that portion of the portfolio. The prior 2 pages was the primary funds. Again, you can see the diversification on the right side of the page. We've seen some nice markups in the portfolio, some liquidity. We have some near-term liquidity events that we expect as well. For example, the second one down on the page, Osaic. This is again Reverence, who I flagged on one of the earlier slides, a co-investment with that manager. That asset is being sold for a mark that's higher than what you see on the page. So excited about that. You'll notice some of these investments, similarly, we go through on a quarterly basis and map performance. Some of them are behind plan, some of them are ahead of plan. We do have one write-off in the portfolio, which is to be expected, a few losses in the portfolio, but that was with one of our strong managers, just ended up investing in a business called Anthology, which is more of an ed tech business and had some kind of COVID disruptions and some leverage issues. So overall, really happy with the portfolio we've built. I'll stop there, see if there's any questions, and then I was actually going to kick it to Steve to talk a little bit about what we're seeing in the market and what we're seeing as we're investing with Advance 2.
Thanks, Jessica. Really quick. So as this one falls into that category of the private structure, in this one, I think the system invested in this in 2021. So, and I think most of the capital has been called. Do you expect to call any more capital, number one? And then number two, what's a expected life cycle on this investment?
Sure. Steve, did you want to touch on some of that? And then
I'll just quickly come in. Jeff and team, first of all, thanks again for having us. As it relates to the capital call activity, we're now at a point in time where the vast majority of incremental capital calls are beginning to be offset by distributions. So said differently, you may get a capital call, but it's going to be greatly diminished in size and scale. We think for this year overall, it's probably going to be 8 to 10% of sort of gross capital calls, but that's going to be offset by distributions. Certainly, as David alluded to, the markets are a little bit choppier right now, but that should probably be a net capital call, maybe 4 to 5%, because we've really seen activity pick up in the last 2 quarters alone. We've had over 50% of the 120 roughly gross proceeds as you've seen back to the product. So the other way we would phrase it is you're kind of now in steady state as it relates to capital calls versus distributions. And then you had another question, I think, on the overall duration of the product. As you see here, the whole period is about a little bit short of 4 years. Given the composition of both primaries and co-investments, I would think about the co-investment portion of, somewhere between kind of 6 and 8 years. And then the primary portion, look, it's going to be kind of 10 years plus. You're sophisticated investors. You've kind of seen that dynamic, within the primary fund market.
Great. Thank you.
Yeah. And then look, I want to be balanced about time here on a Thursday afternoon. Just really quickly, on the backdrop of some of the commentary from my colleague Jessica here, we continue to execute on this strategy. So that manifests itself as Advanced Fund 2. If you look at slide 20, I would just say that the portfolio construction overall and the approach to market is largely the same, with the one nuance being, if you look at that emerging manager versus established manager component, that's kind of moved to 65% emerging as a target, versus what was previously 50%. The backdrop around that being that we as an organization are bedrock, and one of the things where we think we have a real institutional edge even amongst our competitors is within the emerging manager marketplace. As a reminder, that is not just fund ones, that's going to be funds 1, 2s, and 3s. No first-time investors, and fund sizes up to $1 billion in target. So it is still a wide aperture, even within emerging, that we can execute on. And importantly, for Fund 2, which now has about 15 investments, roughly 170 million invested across both primaries, co-investments, and secondaries, is that many more seeded portfolios. We have the ability to see a little bit more maturation in some underlying assets before investing into some of these managers, both on a traditional primary basis and also on a secondary basis, take advantage of, quite frankly, what's been a little bit of a longer tail, fundraising wise, and importantly, be able to do it in a way that has resulted in some really nice alpha early in the life of this portfolio. So similarly to some of the comments, that Jess made overall, you can see that snapshot if you go to the page on slide 25. Don't need to walk through the names in the interest of time, but you can see there a number of seeded portfolios, getting access to oversubscribed managers, just giving early relationships, working with these GPs even when they're at their predecessor firms, et cetera. We've continued to be able to build on that. And while we don't, show any returns here, just given that it's a much younger portfolio, it's right now it's tracking at a roughly kind of 30%-ish IRR, just given some of the embedded value that we invested in when we did consummate a number of these transactions. So let me stop there. See if there's any questions, but want to be really mindful of your time. I know it's been a long afternoon for you and the team.
Hey, Stephen, really quick, within your emerging category, is there any consideration or policy for minority, women-owned, disabled businesses?
Yeah, look, that's a key component of the strategy. As you're well aware, Jeff, the aperture or the language in many of the documentation has been adjusted to be a little bit broader. It just so happens that if you look at our emerging manager landscape and you just look at the opportunity set, a very large portion of that skews towards, underrepresented talent and women owned strategies. Thus far in Advanced Fund 2, everything that you see on this page, I want to say for one opportunity that we're looking at, but we ended up not getting allocation actually, is all alongside managers that fit into that categorization.
Yeah, and 100% of Advanced 1 is as well.
Great. Anyone else have questions?
I do not, Jeff. Not today.
Okay. Well, great. Well, definitely appreciate everybody's time, and appreciate you being able to fit what's of a lot of information into 30 minutes. And certainly I'd love to spend hours on it, but we do have time constraints. So
Anytime, Jeff. You know where to find us.
thanks, David. Good seeing you, bud.
Good seeing you too. Thanks again, everybody.
Thank
All right.
you.
Take
Thank you,
care. Be
everyone.
well. Have a good evening.
Take care, everybody.
Bye.
Okay. Is it time for?
Okay, Jeff, what do you want to do next?
Okay, Sue, I think there's two items we want to do in closed session. So why don't we focus on the two that we don't need to do that for? So why don't we start with the pacing study?
Okay.
And as Sue is pulling this up, I'll refresh everyone's memory on this. This is the pacing study, and I think you even heard the folks at Grosvenor talk about it because they do it on a different level of just understanding all of their underlying private equity managers that are in their portfolios when they take capital and when they give capital back and how all of that gets managed. So we do the same thing for the system for all of the private assets. And so again, the objective here, and I'm going to be really quick with this report because there's really not a whole lot that needs to be done at this point. We've been on pace, if that makes any sense. But the real trick here is we know these private assets, whether it's private equity or private debt or real estate, because they're not liquid, and some of these vehicles can be around for 5, 7, 10 plus years. And the cash flows are lumpy, and we don't know when they're going to call capital often, and we're not sure when they're going to give that capital back. So we have to make assumptions and try to, because the big deal in all of this is that we have an investment policy statement and targets for these asset classes. And so if you think about just a regular equity manager like our Mellon 500, S&P 500 index, or even one of the fixed income managers that's very liquid, if we want to get to a certain target, that's pretty easy. Sue just writes a letter, says, give us, $20 million back, or conversely here, we need to top you up. We're going to give you $20 million, put it to work. That happens pretty quick in that area of the portfolio. That's not as straightforward when we're talking about the private assets. So again, to stay on target, we've got to make some assumptions and do a little bit of digging with all of the underlying managers and their holdings to understand how much we think they're going to give us back over the next year or coming years, and how much we think they're going to call, and sort of offset those things with, okay, and then how many new investments do we need to make in addition to what we currently have in the market to keep us around our targets. So that's what these pacing studies do. There's a lot of moving pieces to it. In particular, the biggest moving piece is just understanding what we currently have invested in the markets, what we have as commitments that can still be called. And so those are all of the pieces that go into this type of study, as well as understanding what our policy targets are. So Sue, if you want to flip to the first page of this. Okay, so this is private equity, and so maybe the best way to look at this is the table below, and it shows what our projections are going out. And those projections again come off of what our target is. So what our asset allocation target is for this asset class, which is 7%, and then all of the current capital that we have, and then what we're expecting to get back. And you can sort of see that graphically up above. So the bars down below, each one of those bars that you see for 2026, 12 million, 2027, another 12, and then 10, those would be what we would expect, or what we think we need to make in new investments to stay on track. So above that, the couple of lines to pay attention to. So the red one with the box, that's the predicted allocation over time. So we want that one to be right on that black line with the triangle in the middle, which is the target allocation. You can see, where it's always kind of a trick is up front or closer in time, because we've got a little bit more information, but we also have to make sure we're making new investments right away to keep us topped up, to make sure those lines are on top of each other going out. So what we currently have, and then what we expect we're going to need on a go-forward basis. And then the other line that you see that's going down is just what we currently have invested in managers and how that will decrease over time. Because again, remember, we'll commit, let's just say, $10 million to a manager, and then he calls all of that and then eventually realizes the investment and starts paying it back. So on a cumulative basis, all of the current managers, if they pay all their money back, that's what that downward sloping line looks like. So again, it's just it's a process of understanding what still needs to be called from current managers, what's going to come back from all the current managers, and then how we plug the gap on a go-forward basis with any new investments. So so right now we've just made a couple of investments in private equity, and we're actually at this point a little bit over our policy allocation. So while you still see there that this study is saying we need 12 million, we've sort of taken care of that. So we really have nothing else left to do in 2026, and then once 2027 comes up, we'll reassess that next $12 million. But what this is telling us, again, is you see that red line being right on top of the black line. It's perfect. We're in a really good spot. So we're a little bit over allocated. At worst, what happens, and this is at worst, which is actually a best, if all of a sudden a bunch of managers just said, hey, we realized a bunch of things and some deals worked out really well, they gave us our money back, and we have a whole bunch of distributions, that takes us off a little bit. We're a little bit under allocated. But again, our expectations from what we've talked to all the current managers about and got their timing and their flows and the expectations is we just don't see that happening. So this is a great picture. This is what we like to see. So again, I think the bottom line on private equity is, and I know we've had a whole lot of search activity going on, and we appreciate everyone's time and hearing all these new managers and making selections, that we're very well on pace here, and we don't need to do anything else this year. So any questions on private equity? Okay, Sue, you want to flip forward one? Or two, I should say. Okay. So similar analysis, but this is for the private debt. But you'll see what the bigger difference is here is that the projected allocation line, that red, is below our target, which is, for this, again, for private debt, that target by policy is 5%. So again, we just had another commitment that we made, so that's going to start ramping up and should plug up this gap that we see for the $10 million for 2026. And again, once some of the other investments that we've made over the past 12 to 18 months are calling more capital, we're going to start to see that red line close up towards where the black line is. So again, while this one's not as perfectly fit as where we sit with the private equity, we're still very much in a good spot, and we're on pace here. So again, relative to to that target, still a bit underweight in private debt, but we are expecting that to increase and shrink relative to the expectation over the next 12 to 18 months with the current deals. So again, I would tell you, just from the activity that we've completed in the last search and with the capital calls that hopefully should be coming in, we're not expecting to have to do any more searches this year for private debt. So we're going to see what things look like at the end of 2026, and then take a look at 2027 for that next what we're expecting to be a 15 million. So that could change, that could be different. So again, this is why we like to do these pacing studies on an annual basis, because some of these numbers can be pretty fluid, but ultimately we just want to make sure we're staying at least pretty close to our target allocation. So also remember a year or so ago when we did an asset allocation study that we did increase that target allocation. So that used to be a target allocation of 3%, and we raised it up to 5%. So we're still also trying to backfill that change or that increase in the target allocation. But again, not a bad picture. We're still in a pretty good position from a pacing standpoint. Any questions on private debt? Okay, Sue, you want to jump forward to? Oh, yes, sir.
Just for my own knowledge, why does the commitment bounce up and down so much over the years on that one versus like the last slide you showed us? Like,
yeah, so that's really going to be a factor of what we're projecting to come back from current managers. So between the managers that have been in the system for a while, and then some of the newer ones that we made, in particular, these funds that we call evergreen, and those are the ones that kind of have an ongoing life. Those can be throwing back distribution. So really, it's kind of saying over the next year or so, we don't expect the managers that we have now or the new investments we made to be giving us back a lot of money. But come 2028, 2029, we think we're going to see more distributions from some of the current managers. So,
okay, thank you.
Okay, and this one's real simple. Real estate, and again, you see the annual commitment level right now as we target it at 0 because we are slightly over allocated to real estate. And in particular, we have one manager that we've talked about that we've been looking at potentially getting out of, and that was UBS. We were in a redemption queue with them a while back. They gave us a nice fee discount, and so to come out of that queue, which we did, and that environment has changed a bit. So their returns, and we can talk about those when we look at performance in a bit as well, have actually been improving. So it's not to say that if they have the liquidity, we might still want to think about paring back the allocation. But right now, what we call the quote unquote liquid real estate managers still are not so liquid. They've got redemption queues. So between those redemption queues on those more liquid managers and then the other lesser liquid real estate investments that we have where money's tied up, we don't see a lot of distribution activity on the horizon. And so with that, we're just there's no need to make any additional commitments right now to real estate. So if things sort of stay the same that they have been, we're kind of right on our targeted line of 7%. So again, no need for any searches this year for the foreseeable future. Questions?
Looks good.
Okay. Well, good. Sue, why don't we jump over to the flash report?
Okay. And the rebalancing, we can do that in regular sessions.
Actually, I'm sorry, I sent you a message on that one. I am recommending we do that in closed just because there's some potential manager issues to discuss in that conversation.
Okay. All right. We can do that. All right.
Okay, so Sue has just put up the February report. So Sue, if you want to flip forward to the first page. And
wait, did we make a motion to go into closed session?
Not yet.
Not yet.
Okay.
Okay, so these are the market metrics for the month of February and for longer term, and you can see for the month on that top table on the left, a little bit of a mixed bag of things going on in the markets. So in the U.S. markets, they were actually down depending on what segment you looked at. So the S&P 500 slightly negative. That 1,000 growth where you see that real big negative for the month and for the latest 3 months and now year to date. Those are all those big technology stocks and the AI stocks and the things that were doing really well for the prior couple of years. We're now seeing investors in the market come back and say, hey, these things got really expensive, and let's start looking at other areas of the market where we can get better value. So we saw that kind of flow going on, and where that shows up most is if you look at the Russell 1000 value right below it, that's sort of the opposite. Those are the real cheap stocks, the things that, they have nice dividends, but folks might figure are a little bit more boring. But that's where the flows are now going when everyone's taking that risk off of the table. And also the international markets you see for the month. Those are the last two lines in that table, top left table. So the one that says EFA, those are the developed markets. Think about Japan and UK. So all of the things outside of the US that are larger economies. And then right below that is the EM or emerging markets. So those are the smaller economies that think about Latin America or emerging Asia, some of those markets. So again, those are areas of the market that have been beaten down for the past couple of years, and now investors are taking a look at these markets, saying if we're nervous about areas of the U.S. market, let's start going outside of the U.S. So that's where we've gotten that bump as well. So the table right below that where it says fixed income, those are the fixed income or bond indices, and you can see was another solid month. So in particular, during the month of February, everyone was taking a look at the potential path of interest rates, of saying the economy might be slowing down a little bit. And so we think the Federal Reserve might continue to lower interest rates. And generally in the short term, that's a positive for fixed income strategies. So that was good. And you see, if you go out to the 1 year period, where, and I'm just focusing right now on the U.S. aggregate, which is all of the investment grade bonds in the U.S. So think about U.S. treasuries and high quality corporate bonds, any issuer of corporate bonds, and then government mortgage backed securities. All of those would fit into that U.S. aggregate category. So kind of think of the safest the segment of the bond market. For the 1 year period at a little over 6%, all of that's kind of indicative of that higher coupon level that we've had in the market. So when interest rates are higher, when any time a company comes out or the government comes out and has to issue new bonds, they're doing it at a higher interest rate level. So we've had the benefit of that over the past 12 plus months. So now that's all of these things that I've talked about through February and for the 1 year period. We're starting to see a bit of a sea change on that in the month of March. So right now there's not a whole lot that's positive in March. So maybe real estate investments are still positive, and anything with a very, very large income component is doing okay, and cash. But outside of that, the U.S. Stock market is down in general, most segments, and the international stock markets are down, and fixed income is down. So, well, what's going on? It's certainly the conflict in the Middle East and is causing some volatility across all segments of the market. And add into that what people are thinking about the impact of this conflict. Well, number one, we see it in the oil prices. So oil prices have gone up quite a bit. And when oil prices are high, that generally translates into higher gas prices. So, and we feel that at the pump. So higher gas prices, higher oil prices, all of that in general creates inflation. So remember we've been talking about it for quite a while now. Ever since COVID, when we had very high inflation. Why was the Federal Reserve raising interest rates? Because they were battling that high inflation number, trying to bring it down to what they call a target level of around 2%. We started to get there. So as of last month, we were hovering right around about 2.5% on that inflation number. So we were really getting close. And then the Middle East conflict hits, and now oil prices and gasoline are going through the roof, and we now have a new level of inflation that is there, but it's not really being caused by people spending more. It's being caused by these other effects. So that's a tricky spot for the economy and for the Federal Reserve, because on one hand, they want to lower interest rates to help stimulate the economy, but they also can't, because if they stimulate the economy too much, it makes the inflation that we now have from the higher oil prices and gas prices, it makes those worse. So that's the tricky spot we're in right now, and that's what really the market, anybody that's trading stocks or bonds or any capital market right now, is they have so much uncertainty that they're just saying, hey, let's just sell everything and go to cash. So we're seeing that right now. Again, we know as a pension fund, we don't do that. So we don't want to, go and take all the money out of the market and put it into cash, because we just don't know when these things change. And as soon as this conflict, does get resolved, that things do turn quite a bit to the positive. So. But again, that's really what's causing this volatility we're seeing so far in March. So again, we're a little over halfway through the month, so we'll see what the rest of the month brings. But as of now, we are giving back a little bit of this performance that we're going to see on the next couple of pages. Sue, if you want to flip forward. Really quick, just taking a look at the asset allocation. So again, how these charts read, the upside down triangles in each one of these asset class categories. That's where the system was at the end of February. The vertical black lines, those are the targets of by policy where we want to be. And then the gray shaded areas also by policy are the allowable ranges. So we can float within the side of those, and that's by design. So we want to have some latitude if we do have big market swings like we've had, to not have to always be rebalancing. But in the same vein, we want to remain mindful of having a policy and understanding when we do need to do some rebalancing. So again, all of those areas are going to be within their policy gray shaded areas. A couple of things to point to, and we'll talk about this one when we go into the rebalancing sheet in a second, is that the total cash all the way down at the bottom of that chart, where you see that at the high end of the range. Well, part of that is going to be to fund an additional manager, and that's also going to bring that global multi-sector up closer to its allocation as well. And then, outside of that, we also have some of that cash that's a good portion of that is also earmarked for upcoming benefit payments and expenses. So, and we'll also have to replenish that as we go through the next year. And then that's the main thing we're going to talk about when we get into the rebalancing discussion. So again, we're within policy here, and no recommendations for changing any of those policy targets today. Again, I am going to have some recommendations a little bit later for how we rebalance around this for what we're going to need for benefit payments and expenses. Sue, if you want to flip forward one. Okay, so this is the performance for the month, and you can see, despite some of those ups and downs and some of the markets that were negative for the month, you still see we were at a nice positive level for the full month. So including all of our different asset classes. And again, this is, I say when we look at this type of market, this is really a market for diversification. So this is why we want to have the system's assets in different areas of the market, why we want to have U.S. stocks, international stocks, bonds of all different flavors, large, mid, small cap, value, growth, emerging, and all of the different segments, because this is really the market that helps us out. And again, as you flip through some of these areas, you see why. So you see the large cap core markets, which the Mellon, which is an indexed product, is slightly negative, and that's all of the big S&P 500. You don't have a manager that's trying to outperform there. You're just trying to be the S&P 500. So that was slightly down. Now, if you go below that, Edgar Lomax, that's that value area of the market. Again, we talked about, and remember that was a manager going back to last year and a year before that, had some big challenges relative to the market, not only because value was out of favor, but some of their particular stocks were out of favor as well. Well, they're making that back very nicely right now. So you see just a very solid month and 1 year period for them. So at 20%, and they're above their benchmark. So again, this is why we like to have all of these areas of the market covered. Again, going down to the growth offset of that with the Mellon, again, that's another indexed product, is negative. And then TCW, they're also in the same segment, but they are stock pickers. They are trying to outperform the Russell 1000 growth. As you see, they have had some underperformance there. So let's, Sue, flip forward one page. And then you see on the small cap markets, again, this is one of the areas of the market, if you went back to the prior couple of years, was an area that was a little bit more out of favor relative to those large technology-based stocks. So this segment has now had a really good resurgence. So you see for the 1 month period, having all three managers pretty solidly positive for a 1 month period, and then going out to the latest 12 months, all of them being above 20%. So again, just a nice way to have a good diversification in your portfolio. Right below that section are your developed international equity managers. You see both of those at very, very solid nominal returns for the month. And then you can see where they are for the latest 12 months as well. Causeway at almost 40%. So they're a bit behind their benchmark, and something we're sort of keeping an eye on, but their longer term numbers continue to do very well. And then your emerging markets manager, DFA, right below that, a very strong month as well, over 6%. And you see that 1 year number at 46%. So again, compare and contrast to a year or so ago when emerging markets just did not look that good. And we said, hey, why are we in something like this when the returns just aren't keeping pace with the US market? Well, these are the types of markets we see now that tell us this is why the diversification into that area makes sense. So Exponent's right below that. That's a global equity manager. So they do everything. They're US stocks, non-US stocks, developed, emerging. They're doing quite a bit of everything. We'll have a little bit more of a discussion about that portfolio later when we talk about rebalancing. Sue, if you want to flip forward one more. And here's the fixed income managers. So again, a nice solid return in aggregate, about 1.3% for all of the different managers. And as you scroll down, your core managers, so those are the managers that are really more in that US investment grade type market, had solid months pretty much across the board. And then below that in the opportunistic segment, some managers doing some different things. So some things outside of the US and some high yield bonds and other areas of the market that really aren't covered by our core investment grade type managers. But again, everything there is still looking pretty solid across the board, and getting that benefit of what's been a more favorable interest rate environment and bonds on a global basis being issued with higher coupon levels. So that's been a pretty favorable environment. So Sue, if you want to flip forward one more. And PIMCO All Asset, again, a very solid month for them. As a reminder to what they do, as their name indicates, all asset means they can do everything. They can be in equities, fixed income, they can be in the US, they can be outside of the US. So it's a fairly flexible mandate. Again, this is a manager that's had some relative discrepancies to their benchmark, and we've had them on a bit of a watch list, but you see their latest 1 year numbers have been really good. So they're almost 20% for the latest 1 year period ahead of their benchmark, and certainly have closed up that gap on the 5 year basis, and then their 10-year number still looks really good. And then the segment below that, your hedge funds, again, the Entrust is one position in a a bond in Peru that we're still waiting to get money back on. But again, given the size, they're a little over $130,000. Their performance doesn't really move the needle at all for the total system. And then White Box and Grosvenor. Again, the difference between those two, Grosvenor, as you heard, they're a fund of funds, so they have investments in a bunch of different underlying hedge fund managers. Like White Box. White Box is more of they're a single strategy, but they're still very well diversified. But they fall into a specific category of all of the different managers that someone like Grosvenor invests in. As you can see, again, those numbers in really strong equity market environments tend to trail a little bit, but remember, as the folks from Grosvenor said, they're not always trying to keep up with the market. They just want to have a nice steady return over time and protect on the downside when we have these volatile markets. So again, a month like March will be pretty telling for some of these managers, just to see how well they do when they protect, assuming we do sort of stay down in the equity and fixed income markets in that period. But again, you take a look at those longer term numbers on a 5-year basis at returns that are just shy of 10%. That's really good for these strategies that again are not correlated or provide a nice amount of diversification. And the great thing about that too is you have that diversification and a manager that actually has a nice contribution to the actuarial return assumption. So they're actually covering your return assumption and then some. And again, doing that with lower volatility relative to the equity and fixed income markets. So Sue, if you want to flip forward one more page, I don't think we have much of an update here. So these are your real estate managers, and we won't have monthly numbers for any of these. They all issue on a quarterly basis. So that kind of covers it. So again, we will have some things to talk about from a recommendation standpoint when we take a look at rebalancing. But otherwise, it's everything has looked good. So, and we'll kind of follow through and see what happens for the rest of March here. Okay, Sue, are we ready to go into closed?
Let me get that motion up real quick.
Did you need me to put that up, Sue?
Yeah, hang on just a second. We got to do the.
Oh, okay, gotcha. Just tell me when you need me to put
Yeah,
that.
we got to do the motion first and then go. So that up. So it's that first motion.
I make a motion to close the meeting and that all records and votes to the extent permitted by law during the closed portion of this meeting be closed pursuant to section 610.021, subsections 1 and 12 of the Missouri Revised Statutes for the purpose of having a confidential or privileged discussion on contract matters.
Second.
Second.
That was a third.
Hush.
So we're gonna call for the roll call vote, Chairman.
Can I have a roll call vote, Sue?
Christina Bennett,
Yes.
Candace Carter Oliver,
Yes.
Lois Cross.
Yes.
Mary Donaldson,
Yes.
William Heisey,
Yes.
Emily Hubbard, Kimberly Johnson,
Yes.
Shanice Johnson,
Yes.
Albert Sanders,
Yes.
Andrew Vian,
Yes.
Doris Walker.
Yes.
All right, so we do have 10, the motion carries. Let me stop sharing and then Jeff, you can share your document. Okay, thank you.
Tax returns.
5 years.
10 years.
I would say 7.
I think it's 7, but if you ask my wife, she'll say for life. So
Yeah,
Seven sounds right.
Is it 7?
7 is.
Okay.
Dr. Albert, we still got that deal?
It's one of those.
Yes.
Okay.
So I got 5. I got 5, 7, 10. Thanks. I'm gonna call the tax lady.
All right, we are live again.
Any other business we have to take care of this meeting?
No.
that concludes
Well-
everything that Mariner has.
Thanks a lot, Jeff.
All righty.
Right on point as
Thank you
you.
very. Yes, I agree. Well, I make a motion to end this amazing investment committee meeting on March 19th, 2026. Conclusion at 6:08.
Second.
We don't need a roll call vote. All in favor?
Aye.
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 Any
Bye,
any
Jeff.
opposed? See y'all next time.
Great. Thank you all. Have a good spring. Enjoy the basketball this weekend.
Thanks, Jeff.
Good night. Thank you. Bye-bye.
Good night.
Bye-bye.
Bye-bye. Hasta la vista.